To remain updated with the latest business news, click on the bell icon.
Hello and welcome to this Business Today Market Special. I'm Udayan Mukherjee, and with me to talk about the kind of pullback we've seen in the market after that disastrous fall post the Ukraine war is Krishna Kumar Karwa, Managing Director of MK Global Financial Services. Krishna, good to see you after a long time. But are you confident enough to say now that a bottom is in place for the market, or is it too early to say that?
So then I think the data and the statistics keep on changing, and as we have no clue about how the situation in Ukraine, Russia will finally settle down. To call the bottom of the market just because stock prices have stabilized would not be the right way to look at things. For us, I think what we should look at is that the high oil prices and the impact on the corporate performances, how that behaves, how that pans out in terms of the quarterly numbers and the guidance for the next few quarters. I think that will be very important to see from a short-term perspective if we have to look at the bottom of the market. Apart from that, I think we have seen relentless selling from FPIs, and it is not only for India, but for other emerging markets also. So far, we have seen that the domestic flows have been very robust, and which keeps able to absorb the relentless FPI outflows. But how long will this domestic investments come into the markets? That is also a key question to look at. So to call that the market has bottomed out, yes, temporarily, yes, it looks like. But if you look deeper into the market, which means that, okay, the headline indices seem to have stabilized. But if you look at the overall the top 500 stocks, more than 60% of the stocks are quoting below their 200-day moving averages, which means that they have all entered into kind of bear territories. So I would be very circumspect before calling the bottom of the market.
Let me rephrase the question, Krishna. Given the circumstances that you spoke about just now, I think should it be fair to assume that some things have changed for the market fundamentally too since the start of the year, and therefore it may be difficult for the market to reclaim its highs or strike out meaningful upside in the next few months?
Yes, I think the whole yes, the market situation has completely changed. Let's put it this way, that this kind of geopolitical situation the markets have never seen in terms of US, UK, US and Russia being almost at loggerheads with each other, and Ukraine being a part of it. My sense is that the whole geopolitical situation, how it is evolving, I don't think so we have an answer to that question. And that will possibly have an overbearing on the market for some time to come. The whole deglobalization, which was picking up some steam even before this, has also got accelerated post this crisis. How this will pan out, again, we are not too clear. So the markets are in a state of flux in terms of how to value stocks or what multiples that stock should be given, A, in a rising interest rate environment, and B, in an environment where there is too much of geopolitical state of flux. So I think that fundamental shift is happening in the market. Let's put it this way, that in the last 10 years, whenever there has been challenges, you always had the US Fed coming in, giving more liquidity, and the markets were in a positive territory, or there was a kind of a bull market which was always there. But I think that card is no longer been available to us. So the markets will have to learn to live with reducing liquidity and a global environment which is uncertain. So I think to answer your question, that today the market, if I have to look at it, is grappling between whether to buy to value or to be in growth. That is a key question. And also all highly valued stocks where we were always questioning in terms of how to justify those valuations, be it in the tech companies or be it into the consumer companies, etc., globally and locally. I think there is a huge question mark on valuations versus the growth that many of these companies are showing.
Now, you spoke about domestic liquidity, and it has held the market up in the face of very serious FII flows so far. But when you talk to HNIs or the kind of domestic fraternity that you reach out to, what's the sense you get? Do you think this kind of resilience will hold out, or at some point do you think even the patience and the courage of domestic investors will be tested?
Yeah, I think the human memory always looks at the immediate past. And today the human memory or the investor memory is colored with what they saw post March 2020. And whoever invested in the last 12, 18 months or did not panic at that point of time, they have reaped good portfolio gains. So that is one reason which makes investors feel that, okay, this crisis also, do we have an answer how it will unfold? Nobody has an answer to that. But hopefully solutions will be found and things will improve. So that is one thing which is holding at the back of the my investors. Second is there are not too many options, which means that interest rates being what they are in terms of, so where do you put your money? So you stay invested in equity is kind of a theme which has become more and more prevalent among the investor community. So this is, I'm talking of the average retail investor who devote time beyond normal as far as their equity portfolios are concerned. The super HNIs, the large family offices who have their own understanding and views on everything, I think they are very clear in terms of that in the next 12 to 18 months, possibly the returns on their portfolios are going to be muted. A lot of gains have already been made in the last 12, 18 months. And with inflation being what it is and nobody has a clue on how high it can go. So portfolio returns will be muted. They take cash calls and they are taking cash calls in terms of exiting equity portfolios and going into cash. So there is a different segments of market. The one which takes active portfolio management, yes, they are taking these kind of calls. But the average retail investor, I think he is staying put, which can be seen by the kind of regular inflows we are seeing in the domestic mutual funds.
While none of us can call the bottom or figure out how this market situation will pan out over the next 6 months, Krishna, the one thing that people do at such times, especially with the way crude has moved, is that they rejig their portfolio. They say, okay, we'll be in these sectors now and we'll avoid these sectors now while remaining invested in the market. Do you think that's a prudent way of looking at it? That you don't take a massive cash call and exit, but you at least realign your portfolio to the new realities?
Absolutely. I think that is what active portfolio management is all about. And you should certainly be looking to do that. And that's what investors are doing. I think there what is happening is that sectors which are relatively underowned, they are showing a lot of resilience. And most of these sectors would be sectors which have not done well over the last so many years and where valuations are reasonable, namely sectors like your fossil fuels, your power, including metals. So these are some of the sectors where there has been a lot of under ownership and they are showing a lot of resilience and maybe possibly they should outperform even going forward. The next set of sectors which I believe can possibly do well would be sectors which would benefit out of, I think, the whole economic life going back to normal now post 2 years of COVID. So sectors like hotels and aviation, or even your exhibition theaters, those kind of sectors, they could possibly see a lot of investor interest. So I think, yes, there is a lot of portfolio rejig which will happen. But the challenge is that in the over the last 5, 7, 8 years, we have all been so much, I think we have just stopped investing in commodity companies and we just don't want to invest in cyclical companies. So possibly the ability to relearn and to take calls on those kind of sectors is becoming.
That's an interesting point, Krishna, because it is commodities which has actually been the biggest beneficiary of this geopolitical turbulence, and it doesn't look like it will relent in the near term. What would you recommend to investors in that space, whether it's metals or it's oil? What's the right way to play commodities now or commodity related stocks now?
Yeah, I think it's very important that I think most of us would possibly have almost nil exposure to this sector. And I think it makes sense to have at least 10 to 15% of your portfolio exposure to the oil and gas sector, to coal, to power, and to metals. I think within metals, possibly I believe that non-ferrous should possibly give you much better returns. But even from the medium-term perspective, ferrous metals also should possibly give you decent returns. Another thing of which probably we never invested in was whole the defense sector. And with global situation being what it is, I would imagine that many of the defense companies also would possibly give you good opportunities to invest in. So I would imagine that wherever there is underinvestment or other portfolios are not focused on, those are the segments which one should be investing in. And because we are not so trained now in the last 8-10 years to put money into commodity, maybe start small.
And what are the sectors in your eyes at this point in time to avoid completely? Because it cuts both ways. I mean, you spoke about some of the commodities sectors which will do well, but the consumers of many of these commodities have already started underperforming. We can see it in various sectors. So in that light, which are the ones not to get into at this point in time?
See, I think before we decide not to get into any sectors, I think we will have to look at the valuations of those sectors. And obviously, the fast moving consumer goods, that segment is facing a lot of headwind both on the demand side as well as on the input pressure. So the margins are also under pressure, and they have been growing below par for the last few years, but the valuations are very rich. So that is one segment which obviously we feel that will continue to underperform. From a short-term perspective, maybe from the next 6 to 12 months perspective, you could possibly see even autos struggle because of high input prices and challenges on semiconductors. I mean, as far as four-wheelers are concerned or passenger vehicles are concerned, demand is not an issue. But yes, input prices have gone up and even production itself is a challenge. So maybe there could be some headwinds in that segment. And I think so that is one segment. And yes, cement is again struggling with high input prices. So maybe for a short term, they could possibly see some headwind in terms of margin pressure, etc. So these are the obvious sectors which come to the mind as far as avoiding. I think every one of us are bullish on the financial markets for the financials, where possibly the balance sheets are the best for in long and credit growth is expected to pick up. But that's an overowned sector. So I would imagine that the returns that this sector should deliver would be below par because of the over ownership. And if inflation continues to be as strong as what it is, then and if credit growth doesn't pick up, then despite all the positives in terms of valuations and the opportunity, this sector could has underdelivered in the last 1 year, and maybe we are headed for one more year of underdelivery.
You spoke about inflation, Krishna. Is RBI policy a bit of a wild card? Because so far the RBI has played along with what the market wants to hear, which is that we are going to be patient, we are not going to press the panic button or the accelerator on interest rates because growth is the bigger focus. But the way crude has behaved and the way inflation is stubbornly staying high, do you think it's a matter of time before the RBI too has to bite the bullet? And what repercussions could that have on the market?
Yeah, I believe that so long as the credit growth, that doesn't show signs of overheating. And if you believe that the high inflation is a function of supply side constraints versus demand being beyond production capabilities, then I think RBI will continue to play the low interest rate environment. But having said that, I think the bond markets, etc., will start factoring in the high inflation, and interest rates have hardened in the last 2-3 months. So we've seen the G6 already moving up. So markets will be ahead of the curve. And if they believe that there are challenges or there are headwinds, I think the bond markets will reflect that. But I think having said that, RBI is very clear that you have to support growth, and whatever the governors have said is about that interest rates will be maintained at lower end.
Now, the one sector, Krishna, which was showing signs of life after many years was real estate. I mean, there was a clear, discernible pickup in the last 6 or 9 months. But now with the kind of how vitiated the atmosphere has become, the way interest rates might go up, all of this, do you think it creates an uncertainty which might stall this recovery in real estate? Because that's not a sector just by itself, but it has such a big multiplier feedback loop with so many other feeder sectors in the market.
So we are very positive on the segment, and my guess is that we have seen a decent uptick in the real estate or residential real estate in the last 1 year, and it's not going away because one is the demand itself continues to be robust, and the segment which will possibly get impacted would be the lower end of the segment, because if interest rates harden, or input prices go up and cost of construction goes up, it will impact the lower end of the market. But the mid and the upper end of the market, that continues to be robust. And whatever little understanding we have of the segment and the tailwinds continue to be very strong. Please, I mean, we may not want to hear that, but the fact remains that the upper end of this upper segment of the population, the upper middle class and the upper class, they have not been impacted in whatever has happened in the last 2 years. It is the lower end of the segment which has got impacted. And demand is driven by the robust organized sector employment opportunities and the way all mid-sized businesses have done very well in the last 2 years. My assessment is that we will continue to see a robust demand as far as the residential real estate is concerned. And now with malls and all also being 100% open, and also your commercial real estate occupancy is also reaching good levels, I think the real estate segment has many more legs to go.
The other sector which has been hot for the last couple of years is specialty chemicals. Is it time to take a hard look at the portfolio of chemical stocks now in the light of how crude and some of the other intermediates have moved in the last couple of months? How are you assessing your chemicals portfolio now?
I think many of the companies have already corrected from their peaks by 20, 30, 40%. Somewhere I think we went overboard on the sector in the last 1 year. And yes, there is an opportunity for growth of many of these companies, but I think we discounted it far too ahead. So investors need to be very, very careful about assessing whether what they exactly call specialty chemicals is specialty chemicals, or some of them have tendencies to be commodity kind of chemicals. A, that is there, and B, valuations. I think we started giving to some of these companies valuations which were at par with the consumer companies, and which is not the correct way to value some of these companies. So having said that, my sense is that the opportunity for these companies to grow multifold in the coming years is definitely there. But I think we have gone ahead, we have moved ahead of the curve in terms of valuing many of these companies. And currently, many of these companies are going through a phase of consolidation and some price correction.
The other kin sector, export facing sector, is IT, where some degree of valuation expansion also happened. I mean, those 20 PE stocks became 30 PE stocks. They have pulled back a bit in the last few months and then recovered again. But do you find enough valuation comfort to be overweight IT from here on relative to other sectors?
So the tailwinds as far as the IT sector is concerned continues to be robust, as can be seen by the results declared by one of the global IT majors recently. The question is that whether the valuation justify what kind of returns can one expect. My take is that today to be invested in IT companies is a good defensive strategy. The earnings visibility is very strong. No doubt valuations are reasonable. But if you expect inflation to be very strong and you expect the rupee to depreciate, then it's a good hedge against good way of investing. But my sense is that IT companies will not give you any great returns because A, they are richly valued and very well discovered. So it's more of a defensive position that you should be having. Can you expect average returns? Yes. But can you expect them to outperform the benchmark indices by a margin? Possibly no.
So Krishna, net, how does it look like at this point in time? Does it look like, it's one of those years where having made a lot of money in the previous year, you can get a small down year and then the journey resumes in the following year? Could it be one of those passing kind of corrective years, or do you think there's a regime change going on? Because often we figure out only in hindsight when a bull market has tipped over into a bear market. Do you have any apprehensions that something like that, something bigger, is happening in the market, a regime change even?
I think we are going through a very paradigm change. And this is, as I said in the beginning, that there is a massive change as far as the geopolitical environment is. And for the last 20, 25 years, we have been used to investing in an environment which was where the movement of capital, people, and goods across the globe was free. Today, what we are going through is a lot of deglobalization, protectionism, and this kind of an environment where possibly we are at the beginning of a Cold War 3, I think the investment paradigms will have to change. Also, in the last 10, 12 years, what we have seen is that in an interest rate environment where it was continuously falling and liquidity was always available, we have been lulled into believing that every fall there's an opportunity to buy. My sense is that the way you value companies, value portfolios, there has to be some change in that process. And but for India, if you look at it, I think we are possibly getting into our best phase. So whatever is happening globally, I mean, we have the market, we have the manufacturing capability, and we have a political environment which is encouraging domestic manufacturing and export. So from an Indian perspective, it should be phenomenal in the coming years. To answer your question, can this 1 year be a kind of a pause? Possibly yes, because there are too many crosswinds in terms of global environment which we have to cross. So from a short term, 1.5 year perspective, maybe we may not see any great returns on our portfolios. But from a medium term perspective, I think it's best time to stay invested or to invest into various sectoral leaders or the top 2, 3 companies.
Krishna, pleasure hearing your thoughts today. Thank you very much for your time.
Thank you. Thank you very much. Thank you.
If you like the video, do like, comment, share and subscribe.